Central bank chiefs are putting us all on notice that the era of cheap, plentiful money is now over. On Monday, Chinese share prices suffered their biggest fall in 4 years as the central bank told investors tight money controls were here to stay.
Fears of a credit crunch in China's banking system have eased as short-term interest rates there fell, though they do remain elevated. The central bank says that there are sufficient funds in the market, but that commercial banks need to improve their cash management and control their lending. Despite the improvement in funding conditions, share prices fell sharply, down 2.5% in Hong Kong and nearly 5.5% in Shanghai, with banks the biggest losers. Investors remain worried about a sharper than expected slowdown in the world's second largest economy.
The Chinese central bank seems to have decided they're going to have a new way of doing business. What does that mean for the economy?
Yeah, I think I saw less concern about that. I think, certainly the companies that I met with, they talked about a difficult operating environment, not an operating environment that was falling apart. So that set that to the side. But in terms of the Chinese central bank, I think most of them really looked at it as, in essence, what we say, which is the central bank was sending a message to the banking system saying, listen to what we're saying because, we kind of hold your financial life in our hands and we're going to make it real clear that there's a new sheriff in town. And I think that's exactly what they're saying. But we all know, and what we've seen is as soon as they decide they want to kind of let off a little bit, you see those rates come right back down.
Yeah, they can do that.
I think it was more about message sending.